Oh, good day, how you going? It's Phil Tarrant here. You might know me, you might know my voice at least. I'm the host of the Smart Property Investments Show. Our good friends over at Finni Mortgages like to get me on once a month to chat about the interest rate announcement from the Reserve Bank of Australia. I'm joined by the Finni CEO, Paul Glossop. Paul, mate, the RBA met yesterday, interest rates on hold, as expected, wasn't it?
Yeah, much of the same. And I think, when we caught up last month, mate, it was pretty much the same rhetoric there. We expect not really much to change between now and the election, the federal election. I think the reality is that we will see change this year. When, and probably the question how many times we see the price of money change will be basically the main topic that we will probably get into later this year and into 2023. But steady as she goes for now. However, that doesn't mean that the banks are saying steady as she goes in the background. We're definitely seeing fixed rates starting to shuffle around, and variable rates, ironically, in some cases, actually getting a little bit more affordable.
Yeah, it's absolute madness. And you think that's counter-cyclical, but I think a lot of the banks are getting in preparation to make sure they shore up the business they currently have or start attracting new business as people start thinking about their interest rates and what they should do. And no doubt if people are in that vote, Paul, they can speak to you or your team over at finnimortgages.com.au. Now, Paul, I spent last week, or the majority of last week, down in Canberra for the federal budget. I'm sort of down there every year for it. Budget week, it's mad. I think the sort of finance nerds absolutely love it. The rest of Australia sort of yawns and says, so what, who cares? It's all just hot air and promises that never come to fruition. I don't know where you sit on it all, mate, but I had a pretty busy week last week. Some stuff coming out of it, winners and losers in terms of property for the budget. What do you got for us, mate?
Yeah, but look, I mean, obviously we could tap into a huge laundry list of different aspects of where the promises are and where the money's going to go, and potentially where the money's not going to go. But if we're talking specifically around the property market, I think there's going to be some aspects which are, I think, some good news, if nothing else. And it's not necessarily what's come from some of the promises from the budget, but the reality is now is that Australians have approximately $250 million in additional savings than where we did 2 years ago. And I think when we put that into perspective, as far as we're talking about interest rates likely to be increasing, as far as official rates increasing later this year and potentially on a cycle upwards for the next 1.5 to 2 years, I think the one thing we really need to keep reminding ourselves as borrowers in Australia, and essentially just in general, is the fact that liquidity, cash in bank, has never been this good. And ultimately, we don't see money rates increasing unless we see some really robust situations presenting themselves in the actual economy. The reality for property buyers and property investors in general, I think from the budget itself, I don't expect really there's that much in there that's going to move the needle one way or the other. There's going to be specifics into certain markets where there's some big investments into defence, which is pretty much a mainstay, into cybersecurity. There was a fair bit of money that was thrown in there as a mainstay. There was some extra money going to rail and infrastructure in a couple of states in particular, probably WA, parts of regional New South Wales, as well as parts of Queensland are going to benefit from that in general. However, holistically, I think there was some pretty good news in there as far as where tax receipts and revenue is coming in, and probably a bit more of a robust nature as far as spending. It wasn't necessarily I would say a chuck the money in every single area and cash grabs everywhere. There was a couple of splashes for some vote grabbing, I think, in general. But for the most part, it was a relatively predictable and pretty balanced budget, I think. And for property investors in general, there probably isn't much in there which is going to stray or give you extreme confidence in a particular market or make you a doomsdayer in any other markets either.
Yeah, we all know we're moving towards the federal election in May. So here we are recording this at the start of April. So just around the corner, 6 weeks or so. So you're going to see a real step change into how the different parties, the government and the opposition, now start ramping up their politicking, their promises coming into the election. We've seen the leader of the opposition, Anthony Albanese, coming out and playing a pretty big hand, I think, in that aged care sector. I think when you look to the government and them hoping to have continuity of government, you see they're trying to address the issue of rising inflation head on. You see in the budget there's going to be some breaks around the sort of fuel excise levies, because this whole sort of notion of inflation, a lot of it's supply side orientated, and this is what the RBA, the Reserve Bank, and the Reserve Bank government is really clear on, pretty much going, okay, let's just take it easy. We spoke about this last month. Take it easy. Yeah, prices are going up, but largely it's because of supply side problems. We have a European war, the war in Ukraine, and that continues. That's really impacting fuel prices and other commodity prices related to it. We still have issues when it comes to construction here in Australia, trying to get stuff into Australia. The cost of a container has gone up rapidly over the last couple of years. So we're not able to get the stuff in Australia. That's the reason why, supply and demand, these prices are going up. But the RBA wants to see genuine wage growth before they start doing anything. I don't think you're going to see the RBA do anything, at least for another couple of months, until data starts coming out towards the back end of the year, what's actually happening. You've pretty much got the job level at its lowest it's ever going to be. Anyone in Australia that wants a job has got a job. I think those people that don't have a job, we should be encouraging them to get a job because we need them in the workforce. But the government's probably pretty happy with that jobless rate where it is right now. So I can't see them ratcheting it up too quickly in time. They want to keep that setting where it is. So on that basis, interest rates should remain stable, at least for the foreseeable future. The call is that there will be hikes towards the back end of this year. Let's see if that plays out. That's outside of our skills and capabilities. We're not economists. We're just commentators of what's going on. But Paul, to get practical with this all, you said there's some sharp variable rates going around right now. You mentioned fixed rates are on the way up. Now is probably the best time, before you get to the point where interest rates going up, to have a look at your mortgages. You might even have a lot of fat in there. You mentioned family balance sheets are the best they've ever been as a result of COVID. People haven't been going on holidays. You mentioned beforehand, people are ahead of their mortgages further than ever before. So people have got all that fat already sitting there idly, maybe in offset accounts, but all that fat also in terms of increased price values now might be the time to strike.
Mate, I couldn't agree with you more. And I think this is going to be a pretty common thread between you and I discussing this. And we've discussed it plenty of times off air over the last few weeks and months, and personally both doing big refinances in our own property portfolios in the opportunities that we see now, is that we've always been big proponents in focus on what you can control. And at the moment, what you can control is the fact that there is a vast difference between certain banks, both in fixed and variable rates. We've seen in the vicinity of 20 up to 40% property increases over the last 18 to 24 months. So if you've already got existing assets, whether it's your home, whether it's an investment or a multiple investment portfolio, the reality is that there's going to be equity in all likelihood sitting in that portfolio. So at the moment, while there is still big opportunity for people to go through valuations, extract equity, get that money prepared, as well as look at your existing rates, because a lot of people who grabbed some of those sharp rates 1, 2, 3 years ago, they're now running off what were those sharper rates, and they're potentially going to be going into what is going to be the rollover rate, which might be in some cases 0.5 and in some cases 1% higher than what you were potentially on. So it's that really key window we're seeing now in the money cycle for investors and people who are looking to get into the investment market to speak to an investment savvy broker to actually go through these processes, because we're seriously talking. I had an email last night from a client who was looking at a Westpac 5-year fixed rate, which if you and I were talking probably 2 years ago, Phil, we're probably talking sub 3% for a 5-year fixed rate in some cases. They now switched their 5-year fixed rate to 5% even for investors. However, that same product for a variable rate with the same bank was 2.89%. Now they're looking at refinancing their principal place of residence by an investment, and you're talking for $1 million. That's $20,000 a year cash flow difference in that one example. And that's with one of our biggest lenders in the country. Now you can imagine, extrapolate that across basically every lender. And that's where these money differences are coming to the fold now. So it probably is one of the most important times that I've personally seen in this money space, that speaking to a good investment broker to go through these processes couldn't be more important.
So what do you do about it? So I'll take your message. Now might be the time to have a look at your mortgages, whether you're looking to buy or extract some equity, get set for when you're ready to buy. What do they do? How do they speak to your team, mate?
But really simple, finni.com.au is all that needs to happen. From there, there's straight away just a link to go into contacting our team. We literally can set up an appointment within hours and then go through nuts and bolts where you're at, what you're trying to achieve from a cash flow perspective, have a look at where the valuations are and figure out what the best loan structures will be for those particular objectives that the individual's trying to get. So finni.com.au, jump on that, and that will get them straight to our team within a matter of minutes.
All right, that's Paul Glossop, CEO of Finni Mortgages. Chat to you soon, mate.
Cheers, mate.